FOMC this week and a host of other. Talk about that today on Open Interest. I'm Mike Coe. Welcome to Open Mic. You may be noticing some video difficulties. For whatever reason, there seems to be a connectivity issue that was caused. We may experience that throughout the show. If so, I apologize for that. But, over the last couple of weeks, I have provided something I've been calling the macroeconomic briefing. I've been putting it on the YouTube channel. I thought it might be helpful. It's a lot of things to pack into a relative to be digestible. And it occurs to me that maybe it would make more sense to touch on some of the immediate upcoming economic releases. I think the potential impacts could be to various asset classes. And in this way, keep it sort of what it had become. So with that in mind, since we have an open mic on Wednesday after the close, and then obviously this one, I'll just touch on just a couple of the things that are upcoming. Obviously, we got this Dallas Fed manufacturing activity this morning, and as we take a look, everybody's kind of aware, how I'm going to choose what I'm focusing on. I've mentioned this before, I believe, I may or may not have, but and really what that's doing is tracking how many people hit these buttons, who have a Bloomberg terminal, how many people hit these buttons. The notification bell on release, so now you can see that these two things turn green. What these bars represent is how many of the hundreds of thousands have said, okay, I want to be alerted when this information comes out. And how that's helpful for of how much focus any given economic release has from the institutional investment traders on the sell side, things like that. Which I think is quite helpful, right? So we know that wholesale inventories are going to be broadly followed. We know that retail inventories, time update on that. So we can get a sense then that these are the things that are going to matter. So as we look to tomorrow, we're going to get the wholesale inventory followed. Somewhat less broadly followed, we have this house price index, but basically if it doesn't get a full set of bars, I'm not going to focus that much time and attention on it. We're going to get the Conference Board consumer confidence number. Now, I like to think of these economic releases in a couple sort of key categories. Is basically sentiment. So does the data suggest that either consumers or confident in the economy? Sort of just like a poll, taking the temperature of investors, business people, and consumers. Some are hard. So hard economic data points are GDP, which we're going to be getting later in the week. Inflation data. So information that is coming from government sources, key metrics that they use to sort of track how the economy is doing. And then the final category is going to be strictly policy. So what are sort of going to be Fed rate changes, Fed minutes, policy position changes from the White House. So for example, we seem to have reached an accord of sorts with the EU regarding tariffs. So that's going to fall into that policy bucket. I go over these things, I just wanted to sort of make that clear that I'm going to be thinking about it in sort of broadly those contexts. Now there's going to be some potential exceptions to this. To know what the number is, when it comes out, and how I believe investors are likely to interpret it and why. So let's just tomorrow morning before the open. So I'm going to get rid of the survey here, just put the survey high and low so we have some sense of it. So a decline of 0.1%. Inventory numbers are one of these things. So sometimes you get a negative number is bad. In this case, a negative number, I think we can generally think of that as being good. If you start seeing inventories indicative of weakening demand. So if something is generally positive for the economy, we're going to expect a couple key things to happen. If we get a good number, so it's looking like it's trending downwards, so there's going to be essentially a drawdown on the inventory side that's indicative of good demand, so probably reasonably good. So we would expect equities to do well. We would expect consumer names potentially to do well. Retail. Oil, in this case, we would expect it to hold where it is or maybe rise a little bit. If anything, when we think about rates, positive economically, as we think about positive things economically, that would be supportive of rates, meaning rates would stay where they are or potentially can rise. One of those reasons is that we're seeing real economic growth. That's a positive thing. Or we might be seeing inflation. Positive thing. So we don't want to see rates rising for that reason, but we don't mind terribly if it rises for reasons of increased economic growth. So in that case, rates, which is usually negative for gold, that doesn't necessarily mean it would be in this case because it's supported by positive economic. Get a decent number. The oil is probably going to stay where it is, maybe go a little bit higher. Consumer names, equities, a little bit higher. Rates stable. Just stable. On the other hand, if the number is worse than expected, worse than the survey, so that's going to be a big build in inventories to fall. Probably not good for consumer names, not good for oil. And while gold would have been stable under normal circumstances, to rise, because as you do stimulative things for the economy from a monetary point of view, that's going to it lowers the carry cost for gold. And so this is a situation where it's not necessarily always going to be the inverse, if that makes sense. On the next one that we're going to be getting is going to be the Conference Board consumer confidence numbers. That's going to be coming out later in the morning. So this is one. So we can just take a quick peek at this. Here too, sorry. Gonna kill that. A situation where a better number is going to be supportive for consumer names in particular, maybe also for cyclicals. It's going to be positive in general, and stable for gold. So the survey number is 96, which is actually an uptick. Actually, I'll put the highs and lows in here of what the bracket is on all of this. So the high end of the survey is interesting, over almost 105. Is actually, it looks like that's also around 95 or 96 even, maybe just slightly above it on average. And why that's interesting is because that last month's survey is sort of out of frame. So even if we mildly beat the consumer board consumer confidence, basically they're expecting this to come in significantly positive from that. So 93 was the number last month. 95 is basically the base with the sort of the mean of the survey at 96. So here too, again, not necessarily going to have a huge impact. which would be supportive of gold, bad for oil, bad for equities, particularly consumer names, and possibly, and this is kind of an important thing about, is that when you get something like that, you might actually see that some safety trades will do a little bit better, and there's kind of a good reason. And staples type stocks, for example, are not going to be particularly sensitive to consumer confidence because people don't stop buying toilet paper. But when you combine that with the potential for lower rates, that could put a higher turn on it, flight to safety, and so on. Confidence numbers. There's also going to be some employment data, the JOLTS employment data. I don't think looked upon, and I'm just going to focus quickly on what's happening in the morning on July 30th, because we're not going to have an open mic before then. And these are sort of the big. We've got the ADP employment change, so that's a private number. That's going to be, a higher positive number is better for the. Better it is for the economy because the Fed's dual mandate is stable currency and employment. If it's indicative of a stronger than anticipated 75,000 at the moment, who is negative 33 the last time, you might also want to pay a little bit of attention to potential revisions, although it's not here. Supportive of rates, particularly at the short end and potentially at the long end too, because that's basically a situation where you have a good economic indicator. If the number is, if we start getting numbers that basically are weak for the economy, along with the front end, so easier monetary policy but lower long-term growth rate. So you can also sort of think about the yield curve as either steepening or flattening. Environment. It's healthy for financials because they pay less on their demand deposits. It's indicative that inflation is under control. Prospects for economic growth are relatively high. That's the good news. The issue that you have with the steepening is that because big purchases like that's not going to sort of fix that housing affordability issue that we've kind of been contending with in here. All right. Data as well, 15 minutes later. Right now, the annualized, but it's reported as quarter over quarter, but they annualize the percent. Obviously, better numbers, supportive of long rates, and potentially supportive of rates on the short end. And it is probably not going to do much for gold. Inverse, you're going to get weakness in those areas, flight to quality on the equity, some gold strength if the short rates come in somewhat considerably. We also are going to have some core PCE price index data. Of course, we know, so it's important to keep an eye on that. And then, of course, the thing that everybody's waiting on, but are they really waiting on it? The truth is that the FOMC, right now, the expectation is for no change. And we had Jerome Powell doing that really bizarre sort of walk around the Federal Reserve's building project. A lot of head shaking and sort of a very strange photo op situation. But the takeaway that we got out of all of that was that all went on his way. The president was asked whether, costs related to all of this construction work or even potential cost overruns were a reason to potentially fire. And the president pretty much dismissed that. I think that's important because, there's a lot of gnashing of teeth efforts to sort of politicize what's going on at the Fed. The truth is that I think that this has as much to do with, it's a convenient thing for the so we actually don't know how bad, I'm being told we don't know how bad this is for you guys. I hope it's not sorry about the choppy video, but we should probably, you know what we should probably do is we should probably record these and then republish it when we have this kind of. This is the issue with doing a production where the production staff is on the East Coast, and the talent, if I dare call myself, OMC thing to pay attention to is really going to be the press conference. So we're looking for hawkish or dovish remarks. We are getting a little bit of inflation data ahead of attention to in the coming days. And again, this is how I just want you to think about the asset classes. Haven't really talked about this a whole lot on my return, so I can tell there's definitely a problem. Yeah. So with that, questions, and hopefully we can get through this without too much trouble. First question that we got today comes from Ranjana Gupta. Thank you for tuning in again. 105 bull call spread in Schwab for $2.50, so you're spending about a third of the price. What do you think of the company and my trade? Thanks. Okay, so first of all, spread or not is going to depend on the context, and that context is usually going to be, do we have potential catalysts? How expensive is volatility? September expiration. So let's start with that. Let's just see how expensive the September expiration options are. So we'll go first to that. 19. So hopefully this will just do what it did not. I was hoping it was just going to go right to that expiration. So what do we have? Vol, 20.5 vol. We'll call it that. That expires in 53 days. In terms of the event calendar, we have the dividend X date. That's really not going to be anything. They have the sales and revenue release on the 14th. So that could obviously cause activity. It's not going to capture the subsequent earnings, of course. It is going to capture part of September, which, as I've previously mentioned, is sometimes a slightly or above average in terms of volatility if we're just looking at different months. Not that I'm a huge believer in seasonality. Things just sometimes just play out that way. Highly volatile for its own idiosyncratic reasons. I would not take away anything from that and say, okay, well, March is therefore highly volatile because way off. So let's just take a quick, okay, so we've got this up here. Let's take a look at this trade. The SEP calls, we saw that trading at 20.5 vol, and 30-day realized vol in white here is about 16. Okay, hold on everybody, we're going to do a little bit of an audio switch. Let me know when okay, so hopefully the audio at least will be better, and you know, we can just if we drop at least this way you guys are going to be able to hear me if the picture keeps dropping out for whatever reason. Okay, so I like the call spread so far. Why do I like the call spread so far? Because it's really been realizing, I mean, just take a look at the period from mid-May to the present. It has never gotten anywhere close to 20 vol, and right now the 97.5s are trading 20.5. And the only catalyst that's going to really propel the stock or increase volatility would be two things. One would be just a general increase in market-related volatility, which we can and probably do expect after Labor Day, and the sales and release that we're going to be getting in August. So I like the use of a debit call spread rather than just an outright, because I think you'd be overpaying a bit based on this chart. So just so everybody's sort of keeping up with what I'm talking about here, I'm just going to shorten this up a bit to 3 months. So if you can imagine, the white line is what you get. The white line is what you get. And I'm going to say the orange line is what you are paying for it if you bought 1 month vol, but actually you're buying SEP vol, which is a little bit higher even than this. So you can see why I would say a call spread therefore makes some sense. Okay. Next thing, as we look at this. So one of the things I would say about Schwab, and actually I would say this about all the financials, if we expect to see some continued steepening, I've said that's good for financials in general. They are in a nice spot from a competitive perspective because since they acquired TD Ameritrade, which effectively is the reason we don't have options action anymore, but from a Schwab shareholder's point of view, there are real synergies in that. You know, you think about the business, and a lot of money could be spent on sort of the war of attrition, trying to attract investors from one platform to another. That's a part of it. So some of that spend that ends up declining pretty considerably. It's not a huge amount, but it's material. You know, we're probably talking about, you know, at least $20 million worth of accretive benefits. You can see that for a company that's doing 23 billion in revenues, you know, 20, 30, 40 million bucks in savings, how much of a difference does that make? Well, it's not huge, but every little bit helps. And I'm sure there are plenty of other synergies too. The other thing I would say is that we are seeing good trading volumes. That's a positive. Higher asset prices. That's a positive. And one of the things I was just showing here, if you didn't pick up on it while I was sharing my screen, this is where the valuation for Schwab is relative to its own history, right? So the historical average is designated by these orange diamonds, and the blue dots represent where we are right now. So you can sort of imagine that if we were trading at historical multiples, where would the stock be? So it's not just under 98 bucks a share right now. If you were using historical multiples, it would be anywhere from, call it 101.67 up to 143.5 bucks on an EV EBITDA basis. Not crazy about EV EBITDA as a multiple for financials. So I'm going to just sort of throw that out there. Think about them more on price to book, price to earnings, but, or, you know, even a turn of revenues, if you will. But it's interesting nevertheless. Go back 5 years so we can have a bigger history. It's a little bit closer, but still it's below on every single metric. It is trading, so that's the good news relative to its own history. You can think about those however you want to relative to the broad market or financials. If we compare that, though, to some of their competitors, like Raymond James, Ameriprise, Stifel, I don't know if you guys can see very well that I'm scrolling through these things on the bottom, that they are trading at a bit of a premium to the group on a forward earnings basis. But I don't know that these are perfect comps, right? Raymond James is not a perfect comp for Robinhood, is not a perfect comp for, I saw Morgan Stanley in here somewhere, I thought I did. I'm not sure where it is. These are probably better proxies, you know, but you've got Robinhood in there, and they've been hitting things pretty well, I think, in terms of their operating performance, but traded at a much higher multiple. So I like the trade. And finally, I don't know if this was a question, but as you're thinking about whether or not you're going to put it into a call spread risk reversal, so you have this unfilled gap right here. So that represents a downside risk. You're in a call spread, not the stock. So you're in a call spread because it hedges you against that risk. So I would say that, you know, that would be sort of the thing I would look for before I would go into a call spread risk reversal where I would sell puts, is see whether this is potentially in play. At the moment, everything looks good technically, but that's sort of your first point of vulnerability. If it breaks through that, but everything else remains intact, and maybe you hold above the 150, that might be a good time to sell the put. You're going to see elevated implied volatility in that case anyway. So kind of one of these things where if the rally just continues and it starts working, I mean, you're right at your long strike, runs up to your high strike, this 97.5 gets north of 60 delta, you can look to adjust it and roll up and out. But that's how I would look to handle that. Eileen commented that it's supposedly boiling hot on the East Coast today. I don't know. Apparently, I just learned this. We are having a very cold summer in the Bay Area. I hadn't personally really noticed much of a difference, but I did go out to the New York area, and when I was there, it was quite hot. That was a couple of weeks ago. I'm back now. Okay, how to play Amazon into earnings this week, if at all? Well, let's take a look. So, first of all, even before, normally I would say let's look at a chart first, but I'm not going to do that. Flip the script a little bit. First thing I'm going to do is say, okay, what do I think of valuations and what are the street's expectations right here? We are trading at, well, I'll call it 233 on full year estimated earnings of 793. So we're trading at 29 times full year earnings with an adjusted EPS growth rate of 41%. Not unreasonable. Cash flow of about 40, call it 39 billion bucks. So it's not like it's a huge cash flow generator on a relative basis, but it's still all right. But really, as we take a look at next year, if these numbers are legitimate, so we have, let's call it an anticipated free cash flow yield of 2.6 with a very nice free cash flow yield growth rate year on year. And it's trading at about 26.5 times forward earnings with 11% adjusted EPS growth rate. Highly diversified business in all the right places. I'm fine with it. I mean, look, a lot of things are going to look a little bit extended here. They always do. We're close to all-time highs, and when you have stocks trading at all-time highs or close to it, it's always possible to get a little bit anxious. Let's blow this out a little bit so we can give this a little bit more context now that we're getting to that. So this is the tricky bit from a technical point of view. And that is, we've got these highs right here, so 242.5-ish. We're not far off of that. That's not a whole lot of upside from where we are right now. Would stand to reason that you could bump into a little bit of trouble at that level. So I like the stock on a fundamental level, but just taking a look at the technicals, we need to acknowledge that that's a potential point of resistance when we get to that. So we'll now just go and take a look at the more successful technical indicators over the most recent period. Almost all of them are bullish, and not surprising. We're not far off of those all-time highs. Oops. 1 second. Oh my goodness. Sorry. Bear with me. I was supposed to send something out, but because we were having a little bit of a difficulty. So Starbucks is going to be reporting earnings tomorrow. Got a pretty big implied move. Puts were outpacing calls, folks. We saw 2.7 times average put volume. You're hearing it here first. If you're going to watch CNBC, you're going to hear this in just a little bit. And 85 puts. So the Jan 85 puts were the most active. And let's see. We had 5,000 of those trade at an average price of almost $4. All right. This is the problem with having technical difficulties. When you've got back-to-back video stuff going on, you're trying to sort it out. You forget to do all your stuff. Luckily, we're not flying a plane right now. If we were, these things on the checklist would be pretty disastrous. Okay. So Amazon valuation is on or about the valuation of the S&P generally, but it is growing the top line faster. It is growing the bottom line faster, and it is growing free cash flow faster. So, and they're in all the right businesses. So So far, so good on that point. In terms of a valuation relative to its own history, which is what we were just looking at before, so we might as well look at it here as well. A little bit more of a mixed bag, but on a forward price to earnings basis, it's below average. If we went and looked at this on a forward price to earnings basis going way back, people did not used to price Amazon on price to earnings. They priced it more so on EBITDA, enterprise value to EBITDA. So that was really the thing they were looking at. The argument for this was the company kept reinvesting in their business. So people were not that concerned about earnings. They were concerned about growth. So they wanted to see revenue growth, and they wanted to see EBITDA growth, and they wanted to see the company continue to invest. And the argument was that they can round the corner and turn on profitability. Those of you who watch this live stream a lot will know that I've made similar comments about Netflix, and it was a very similar story there. So the fact that the multiple here is, kind of mixed and in between, not terrible, but you can see that EBITDA, which was the preferred metric, it is a little bit higher than it was. So if the stock was trading at its mean EBITDA over the last 2 years, and let's go actually even further back than this, and we expect it to get a little bit of a premium to that historical multiple because they, in fact, did prove that they could increase their margins. So on a 5-year EBITDA basis, that's $216. That's actually not a huge discount to where the stock's currently trading. 7% cheaper than it is currently. So a little bit of a premium, but not anything I would be too terribly worried about. I would just be a little bit concerned about the fact that it's, right near this all-time high, and then it might bump its head there. So hopefully that's helpful to you. And let's just take you were asking about earnings, so we might as well just take a look at what the street's expecting and how big the implied move is. So the implied move is relatively cheap. You see this? That means that the options are cheap going into it. So if you're inclined to make a bullish bet, don't sell options going into this, implying less than a 5% move, which is significantly less than the more than 6% that the company has historically averaged. The adjusted EPS that the street is looking for is $1.32, and here you can see some of those historical moves that we've gotten out of it in the most recent reported quarters. Yeah, so hope that helps. Let's see here. Did I skip one? I just want to make sure I'm not doing that. So Michael Kane says, I am long hood since 31, large position. Instead of selling some shares before earnings on Wednesday, I was thinking of selling calls at the 105 strike expiring Friday for $5. Thoughts? So those of you who follow know that I'm not usually crazy about selling covered calls going into an event unless the implied move is higher, substantially higher than what we've seen in the past. Now, the newer a company is, the more we have to kind of take a look at what the trend is, right? So if we take a look at a really mature business, JP Morgan is a really mature business. It doesn't move very much on earnings. Companies right after their IPOs, number one, the stock tends to be more volatile. And number two, oftentimes there's more volatility around those early quarterly earnings releases as investors are trying to see whether all of the pre-IPO promise translates into post-IPO operating results. Robinhood is not quite in that category, but it is a newer business, and it has exhibited significant volatility around earnings, which we can see here, right? So you can see that there's been quite a few instances, 1, 2, 3, 4, 5, 6, 7 instances just since, in less than the last 4 years where we had double-digit moves on their earnings release. Let's see. So if you were going to sell the 105s, I'm curious, Michael Kane, I am curious. So the 105s are in the money. So your standstill yield on that would actually be not that great, right? You're looking at 3%. So I'm not super crazy about that, I have to say. The implied is decent, but at 8%, but well justified, right? And selling an in the money call, you have to think first about the extrinsic premium. So that's going to be the total amount of premium less any intrinsic value, which in the case of the 105 calls is almost $1.80 here. So there's only $3.23 of extrinsic premium. So that's really what you're going to collect out of it. So you're getting a partial hedge. I guess you could say that. Oh, the 106s. Yeah, the 106s are also still in the money. Yeah, I mean, I don't know. I mean, I feel like trying to scrape an extra, 3-4% out where you basically have a lot of potential risk to the downside. So you get a 10-12% downside move, you will have softened the blow. But if you get a 10-12% upside move, you really sort of clipped yourself. So I'm not super crazy about that. In general, I'm not crazy about selling options going into outright like this. If you're selling call spreads, or if you really think that the valuation is too steep, then you can look at things like straddle swaps. This is a good example. I like straddle swaps when the implied move is really chunky. And a place where I think the implied move is pretty chunky is in, for example, Dash. So I think DoorDash, I was looking at this over the weekend. I actually don't know what the prices are now. Yeah, look at this. So implied move is 2.5% higher than the long-term move, and it's actually greater than any of the moves over the last 4 quarters. So if you were telling me the exact same story in DoorDash, I would say, yeah, I'm a little bit more okay with it in that case, right? But in Hood's case, I don't think you're getting quite as much as you deserve. So that's probably not the way I would do it. Just my 2 cents. Take it or leave it. Okay. Alex B, what do you think about NuScale SMR as a nuclear power play reporting on August 7th? I think I've mentioned before that I kind of liked Fluor because Fluor has exposure to NuScale, which I thought was, and beyond that, I thought, it just has sort of a valuation benefit. It was not trading particularly rich. Actually, it looks like it must have gotten a little bit of a bump because it was when I was mentioning this to you guys before. Oh yeah, look at this. Thing's had a huge run since then. Okay, so I mean, you guys probably remember that I had mentioned Fluor, and was trading in the teens. It had exposure to SMR, but was trading below its historical multiple, below the S&P. Still had some decent potential growth in there. We're going to take a look at this resistance, but we met my other criteria: potential top line growth if the economy is doing well. This is one of those engineering construction businesses that I also thought was poised to do well. And it's not just the small modular reactor exposure. These guys are also important on the construction and engineering of building new reactors. So whether it's for NuScale or anything else, also recommissioning or decommissioning other nuclear reactors. That's all sort of within Fluor's capabilities and remit. So I kind of like the business for that reason. But as we looked at it just now, I was thinking to myself, are we also here getting back to a level where we're approaching potential? Yeah. So lo and behold, I mean, you guys can go back and see whenever maybe the producers or savvy producers can calculate when we actually did that video and I talked about Fluor. In fact, I think it was actually sort of the topic that I led off with the day that I did it. I realized this was going to be some time ago. Wow, has this thing had a move since then? Yeah, so we are now. Yeah, we are. This is going to be a ticklish level. So, that's if you're doing it on the floor side. So now let's take a look at it on just trading new scale, which is going to be more speculative because this is a thing that really moves around on earnings, as you can see. I mean, we've had double-digit moves each of the last 3 quarters, and the one before that was 8%, all to the upside. This is always going to be trading at this point largely on its promise because it's a pre-revenue business, right? So you're looking at a $14.5 billion valuation with no revenues, effectively no revenues, $60 million in revenues for a $14.5 billion company. And that was one of the reasons why I just kind of like Fluor, because if anything sort of turns south on this, there's a lot of potential air in there. But I wonder if we could do, so what did I just say the implied move was? %11. I mean, given what we've seen recently, I once again, I mean, you take a look at the long-term average and it was much lower, but I like to try to focus on what's been going on more recently. And unlike sort of what I was talking about as businesses mature, you'll start to see their volatility fall. This is still a pre-revenue business, so there hasn't been any opportunity for maturity. It's just, is a deal going to happen? Is it not? I think they were going to be building something in Washington State, and then that got delayed, and then it didn't happen. And so there's a lot of things going on here that can impact it. I don't know if you have a big position in it, but I think call spreads are a decent way to play it on the long side if you care. But some of these things have had a heck of a run. I don't think I'd be reaching out and grabbing the stock here, but I'm still okay owning Fluor. I don't own SMR, but have certainly had exposure to Fluor on numerous occasions in the past. Okay, James Forbin says, I used ChatGPT last week for the first time to assist me setting up trades. It's pretty good with rolling out trades. It's like having my own virtual Mike Coe on the phone guiding me. Well, I have a feeling that ChatGPT doesn't tire, and you can ask it whatever questions for as many instances as you like. I will tell you, I think these large language models have great promise, and I would not be surprised at all if sooner rather than later, you're not going to need too many people with lengthy experience or expertise in certain domains. It's still lacking a little bit on the option side, and one of the ways I think it's doing so is that when you run your searches on this, and so this is just something for you to examine, whether it's Chat or Grok or Gemini or whatever, they often will cite the sources that they used. And I'm not giving any knock on any of these sources. GetInvesting.com or Schwab actually comes up pretty frequently as a source in those. But a lot of the time, my finding is that it's these heuristic approaches to options trading rather than specifics related to the events at hand. That's the first point I would make. The second point I would make is that what I'm always hoping for is, and I mentioned this on a prior live stream, something novel, right? I would like to know, what is the bleeding edge of options research? What is it that people are looking at now? I can remember when Garch models, early in my career, people started using Garch models, and when people started using other types of binomial models for pricing, there were a lot of different approaches to trying to solve how you value options, how you think about volatility, skewness, kurtosis, how fat or fat-tailed the distribution was, how much skew it exhibited. Those weren't things that happened when the model was first used. People had very flat pricing. Event variance wasn't something that was all that well understood. In the early stages, things like dispersion and correlation, the relationship between index options and the constituent stock options weren't very well understood, number one. And certainly they weren't very well priced either. And there were functional reasons for this, right? Because in many cases, market access was not as easy as it is now. You actually had to call floors. Trading was much more manual. there were a lot of things that could cause those types of problems. So what I'm seeing when I look at large language models is that it talks a lot about sort of general best practices, which is great. Start with best practices. If you don't know the answer, at least start with that. But they have not really gotten into much more nuance in some of these cases because of that. But maybe your experience has been better. I'm using the paid versions of these things like Grok. I didn't get the highest one in Grok, so the highest one's like $300 a month. The one I'm paying is like a tenth of that. So, yeah. As the producer said, sorry about the choppy video, but I'm hopeful that the audio is a little bit better now. Alex V asks James Forbin, are you using an API to connect ChatGPT to your broker? Interesting. Yeah, I mean, look, the way I do things, why not? I'll just show you. So I'll just pull up my Super Grok, right? So this is the paid version 4. I just use it like this and ask my query, is it a good idea to sell covered calls ahead of earnings? You could ask a question like that, and you'll see what's going to happen. This is a very general question, and so as you would expect, I'm going to give you very generalized types of answers. And if I look in here, now I get Gemini working on it for me a little bit, and you get the links right here. But this is kind of the part that I think is really interesting or important. I don't know if it shows very well. Let's see if I can blow this up a little. Blow that up. So this is the section over here that I'm interested in. But take a look at what it's referencing. Investopedia. Nothing wrong with Investopedia or Insider Finance or VectorVest, NerdWallet, and things like this. But Charles Schwab, remember I told you that this is frequently a source. It's not surprising because these are the entities that are going to have published a lot of data. But what I'd really be interested in is some of like Matt Amberson's work at ORATS, where they did an examination of like 10 years worth of data selling covered calls going into earnings for all optionable stocks. And what they found was that in the general case, they were at best fairly priced and frequently underpriced. Now, if I was asking Matt those questions, does that necessarily mean, okay, so you don't do it because of his work? I would still have so much follow-up work. So, for example, I know that there are trends that take place. And as people become acclimated to the fact that maybe options were underpriced going in, you can start to see a secular shift. Like there has been a secular shift in skew. There's been a secular shift in kurtosis. There's been a secular shift in event variance. And there's been a secular shift in implied correlation over the course of time as people began to recognize failures of how they priced options and volatility in the past and incorporated that into how they're priced now. So then, all of those are the things that I really hope to get out of it, and that's not usually what you do. But it certainly is a good starting point. I would never say that it isn't a good starting point. And you can see how quickly it provided answers. So that's all really, really helpful. Yeah, so apparently so the producers made me small so that you can't see if I'm getting all choppy. You probably should do that anyway. Nobody wants to look at my ugly mug. I have the face for radio, I think, right? Maybe not true when I first got onto television, but it's been almost 2 decades now, so very, very different. Yeah, and then Michael Caine was following up on the calls that you were selling in Robinhood, saying it was the 106. Those are still in the money. If you're selling upside calls or call spreads, up in and around the implied move to the upside to milk a little bit out, but if they totally blow the doors off, you're not going to be that badly hurt. I don't mind that. Yeah, covered calls. if the implied move is less than what it's been realizing lately, that's probably a little bit not worth it to me. Tucker to Dog says, I would never connect an AI to a production system. And I'm assuming that Tucker means production trading system. Let me tell you, I have had some miserable, Finwest says me neither. I've had some miserable experiences just with algorithmic trading. Forget about AI. I'm just saying circumstances where I used what we called them auto hedgers. Okay, so auto hedgers are things that would monitor my deltas, and if I had trades that were going off where I was working big interests and I was trying to maintain a certain delta to the underlying, it would just automatically fire off trades on the other side. So very simple and straightforward stuff. And I can remember distinctly Federal Express, probably regaled you guys with the story or tortured you with it several years ago. But I was working a big block of FedEx calls that I was selling, but I wasn't exposing the whole order. So I was piecing them out. I had, I don't know, it was like 1,000, maybe 1,500 of these upside calls to go. The stock was trading in the low hundreds, like $120 ish or so, if memory serves. And, they were going off at 50 a clip. And, this is going to be a good question. We're going to have to get that. But at some point, somebody sort of figured out that there was an order sitting there and they wanted to lift them all. And so even though they were iceberged and designed to be pieced off, they just sort of went bang, bang, bang and started lifting the calls in rapid succession. Ended up trading, actually, now that I think about it, let's see, how much did I, it's $2 on 140. Yeah, it had to have been at least 1,500 calls now that I think about it, because they were out of the money calls. I was buying stock, lost $140,000 on the hedge. So, assuming they were 40 delta calls, I must have been trading a pretty big block of them. And I basically, the big board got a block order to buy my hedge, and they printed it just under what's called the obvious error rule. And so algorithmic trading is super helpful, but boy, do you have to be careful. That's how Knight Capital blew up, right? Smart people, good coders, I'm sure, made a mistake, and they blew the whole firm up in 20 some odd minutes. So, letting the machines have complete control is a very risky business. Okay, so let's talk about this question that we just got here in Palantir. So this is interesting because one of my former colleagues pinged me today and said, why isn't Palantir down more today? What were they talking about? And did I get that up there? Oh yeah, play Palantir into earnings. What are they talking about? For anybody who doesn't know, Palantir was down today, not very much, still trading very close to the all-time highs. What was the news that hit? Microsoft. The Department of Defense is apparently testing an AI model from Microsoft. So, it didn't hit it very hard, so the market's kind of dismissing that as a concern. In fact, I think Microsoft actually was off more than Palantir today, if I remember when I was looking at it. Yeah, so we've got, this one's down 20 bips, and Palantir was down, how much? I don't know, I guess it was a little bit more, 60 basis points. But, in the grand scheme of things, you would think that having an 800-pound gorilla like Microsoft, playing in your sandbox would be a little bit nerve-wracking for Palantir shareholders. So as we go into earnings, let's just take a quick peek what the options market is implying, what kind of moves we've seen in the past. 10% implied move. Boy, that seems actually pretty cheap. I mean, when's the last time it moved less than 10%? Has it ever? Once? Wow. So 2 years ago, it moved a little over 5%. November, it moved just under 10. Yeah, this is so options are very reasonably priced. You want to make a play in Palantir, I don't care which way you're betting. Using even just debit spreads, if you feel like the outlay otherwise is a bit too chunky, very reasonably priced. Still not surprising. We just looked at the chart, right? So the momentum's clearly with it. I mean, there's only a couple things that are suggesting that it might be getting a little bit offsides. Only, look at this, of the winning technical indicators over the course of the last year on a daily basis, only one, the worst performing, the moving average oscillator, is suggesting it's a sell right here. Wow, this thing has had, isn't it amazing? It's just amazing what kind of a run this thing has had. But I mean, I'm not gonna. Valuation hasn't mattered a great deal for this for some time. Look at this. What is that? 90 times. 90 times revenues. This is the one thing I would say is that as we think about this, where does this thing have to land if it matured to justify its current valuation? So let's take a look at a big defense contractor like Lockheed, right? So Lockheed has 20 times the revenues and is worth 28% of what Palantir is. Slightly more, a third, I guess, if we look at it on an enterprise value basis. Palantir's got its work cut out. It's definitely going to, at some point, this is going to be a show me story. But, this is really just more of a frenzy stock right here. And I think options are very reasonably priced going into the event. And in fact, let's just go back a couple of years here to, we'll go like that. And we're going to take a look at, so these are the big moves that we've seen. And we can take a look at where options are currently priced going out 1 month. That's here. So looking at the last 8 quarters, 2 times you got your money's worth. And every other earnings, the things were just an absolute bargain. Could this be a much lower number this time? Maybe. But yeah, I mean, those options to me, no matter what your directional thesis is, those things are a buy going into it. Okay, so Alex V says connecting AI for anything doesn't have to be automatic. Yes, no, and it shouldn't be. It would be nice to be able to generate a ticket draft from strategy and be able to just submit it at will. Yeah, I think that makes a lot of sense. Anything that can streamline the process, I'm hugely in favor of that. And throughout my career, it has been technology has supported better trading techniques and approaches over the course of time and increased automation. We built all of our own systems in the late 90s and early aughts to trade. And then I went to floor trading on the NYMEX where it was all literally off of paper. Paper tickets, paper sheets, and then that became automated and electronic as well. There's no sense trying to figure out what an option is worth by taking a look at where something just traded and then looking at some sheets of paper with a matrix on it and saying, okay, well, I think vol is here and it looks like the underlying price is there and that gets me. I mean, that's just dumb, right? And there's no need for it. It's good to have that in your back pocket in the event that there's a huge technological collapse, but that was only true back then when trading was open outcry and could take place under any circumstances anyway. Now, it's actually not important because if all the systems crapped out, they'd probably just have a trading halt. So there's no benefit to being able to do something in your head if no one can trade with you anymore or will. So, I definitely believe in using technology and technological approaches to do this. And, that's great for triggers, right? So if you say, oh, I would love to own the stock if I could get it at price X, I would like to buy vol if I could get it at 30, but I have no interest at 42. then machines are the best way to monitor that, because you can be doing other work. What are you going to do? Stare at it all day and see whether it goes your way? That's hopeless. So I wholly agree with you, Alex. I think that makes a lot of sense. But I would urge significant caution for those who are thinking about it on anything that would allow machines to trade your money based on a couple criteria set and allowing the machines to make that decision, because that hasn't worked out particularly well for me. And it certainly has been disastrous for some. But your mileage may vary. Okay, so I have 2 pages here. Did I skip questions? We got to Finwest, Nike, looking good today for a change. So I didn't address that. I don't know how I missed that, because I certainly, if I noticed it, I would have said something. And what I would have actually said wasn't necessarily related to Nike, but let's take a look at Nike first. So, Nike, to my eye, is not cheap. It is priced off a presumption that they are going to be able to sort of regain their mojo, their historical mojo. And I'm not entirely convinced that that's true. I don't think they're going to get back to 15% net income margins. I don't think they're going to get back to that same historical level of growth. I am supportive of the CEO who was formerly of Nike, because he has a long and successful operating track record of the company that goes back decades. So I am in favor of that. What is interesting is that we got some results out of Deckers, and the stock popped. And this one, these companies, the ones like Owen Holdings, Deckers, which has Hoka, these are companies that have top line growth, right? These companies have what Nike used to have and that people want. Now, I could understand saying, look, Nike is a famous brand. It's a historic brand. It's got great people running it. All of those things could be true. But if you're buying it at its current turn of high 30s times full year, relative to buying something like this, which is not trading more richly, but actually is growing, that's where I really struggle. I mean, let's just assume that these margins are optimistic. So let's just take a look at 2027 fiscal year, which is really mostly calendar year 26. So we'll call it 5,900,000,000. 15% net income margin gets you to 885. Okay, in net income. And so you're trading at 18.8 times next year's estimated earnings on a 10% growth rate. Or you could trade Nike at 37, 38 times full year with no growth. And a similar assumption being made by investors of a 15% net income margin. So to me, I just have a very hard time with that. I don't understand why, everyone's plowing into, maybe you see something that I don't, but I think we had an unusual period in Nike's history, and they have just a lot more competition now, and the thing's just not cheap. So, yeah, that's kind of where I'm at with that. Okay, so with that, we are going to wrap it up because it has been the full hour. I think I've taken most of your questions. We're going to be here on Wednesday. I will go ahead and discuss the economic releases that are going to be coming out for the tail half of the week and their potential implications at that time. And one other quick point is that very likely there is not going to be any stream next week. A couple of reasons for this. One of those reasons is that the producing staff on the East Coast are probably going on vacation, which would make it more difficult. Making it even more difficult than that, though, is the fact that I actually have never, ever taken my kids camping, and they are teenagers at this point. Something my wife pointed out. Never gone camping with the kids. And So before they are all off to college or something like that, we're going to give it a try, and go sleep in a tent in Oregon or Washington or Northern California or something like that. At least that's the plan if the kids are on board with it. So maybe I'll be able to do a hit here or there, but it's probably a safer bet to suggest that it's going to be difficult for me to connect from the wilderness. I'm going to be more occupied trying to make sure that my lunch doesn't get eaten by the neighborhood bears. So, yeah, and let's hope it's only the bears in the woods and not the bears in the markets that are eating my lunch too. Anyway, with that, I will see you all Wednesday. Like, subscribe, notification bell, all that good stuff. Tell your friends. Thanks for watching.